Let's talk some more about the risks to your money heading into the new year. Bob Pisani is live at the New York Stock Exchange for us tonight. Hey, Bob.
Hello. Happy New Year, Scotty, and everybody there. With the markets up almost 30% this year, you know, it's put up or shut up time, really. We're ending the year near historic highs because traders have come to believe there is greater clarity on what I call the four horsemen that have moved the markets all throughout this year. First is a trade truce that's now likely. Second, the Fed is neutral and unlikely to raise rates in 2020. The U.S. consumer remains strong. Low chance of a U.S. recession in 2020. And finally, the global economy is showing signs of bottoming, or is it? Now, December has seen a slow melt-up on light volume, but when the adults return in January, there's going to be a little bit of a reckoning. The market has largely priced in expectations of a real trade truce and a bottoming in the global economy, but it's not clear what kind of truce we're getting, nor is it clear that the global economy is exactly bottoming. So, for example, November Japanese data on retail sales and industrial production released last Friday was already poor. So is the South Korea data over the weekend. This week, we will see critical data that may or may not confirm this global bottoming theory. So we're going to get China PMI and the services PMI tonight, Eurozone PMI on Thursday, U.S. ISM manufacturing on Friday as well. Policymakers may look past weakness in Q4, but it's not clear that investors are going to do that. So even without this weaker economic data, the market is already notably overbought and due for a pause. That's what we saw today. The 14-day relative strength index for the S&P 500, it's a momentum indicator that's widely watched by Wall Street technicians, is at 78. That's the highest level since January 2018. Any reading over 70 is overbought. Readings near 80 are very overbought. Hard to move the market forward. That's what it's telling you right now. A pause like today, therefore, is welcome. The market does a little bit better with 2 steps up and 1 step back. It'd be nice to get a little digestion before another leg up happens, and I think, Scotty, that's exactly what happened today.
Yeah.
Back to you.
Bob, we appreciate it. Thanks so much. Bob Pisani, New York Stock Exchange for us. You know, Santa Claus rally does typically last into the first, handful of days into the new year. That's one thing. And the other thing is when you have a strong year the way we have had in 2019 for the S&P, when you're up this much, better than 20%, you are up 75% of the time going into the next year. Yeah. And not only are you up, you're up double digits. On average, like 11%. So history is on the side of the bulls.
Right. And the S&P, I hear what Bob's saying on the RSI relative strength index, but it has a knack of working it off pretty quickly. So I think any sell-off that you see will be short in duration and a buyable event.
Last comment?
Oh, no, I thought you were about to read.
Well, I feel like we should hear from you.
Do you?
Hot shot.
There's a lot. Hot shot. I'm just saying, there's 45 minutes left in the show.
Patience.
My quick pushback would be, don't confuse the U.S. consumers.
If you don't answer the question, we can only have 43 minutes left.
Strength. I don't believe in consumer strength. They shouldn't be spending. I mean, think about it.
What do you mean?
Consumer debt to GDP is 54%. It's at ridiculous levels. You talk about people living paycheck to paycheck most of this country.
Wages are increasing for the first time in years, and they're outpacing inflation.
The U.S. consumers want to spend is always there. Their ability to spend, I don't think, is there. So if the market were ever to go lower, you see how fast they'll stop spending. Go back to October, November if you want proof positive of last year.
Well, of course, but that doesn't mean that the consumer's not in decent shape.
People look at the. Pardon me?
That doesn't mean that the consumer's not in decent shape.
They're not in decent shape.
If I tell you the market's going to go down 40% or consumer's going to cut back.
Unemployment at historic levels.
The consumer, I'm just telling you right now, consumer debt to GDP is at levels that are unsustainable. I don't care where rates are.
Yeah,
they're completely over-levered.
That debt is now financed over 30 years at a historically low rate that's fixed.
So let's keep playing that game and see how it works out.
Aren't you glad I asked you for another comment?
Well, that's why you got yourself into it.
Whether America is or not, I'm not sure. But are you?